In this quick video, I'll simplify consolidated statements of profit or loss. I'll take you through 3 adjustments. First, we'll do intra-group trading. Then we will look at unrealized profit. And lastly, I'll take you through dealing with a non-controlling interest. Let's get started. I have 2 companies on my screen, company P and company S. Let's imagine that P acquires 100% of the shares in S at the beginning of the year. This means that S is a subsidiary of P. P controls S, so we'll need to prepare a consolidated statement of profit or loss in a moment. Let's start by looking at their trading for the year. Company P makes $10 in sales on a cost of sales of $8. So company P earns a profit of $2. I'm intentionally keeping it simple. I'm just calling profit a generic profit line. We can complicate it later. Now, those sales were made to company S. So that means the sales in P will show up as the cost of sales in company S. Now let's imagine company S sells those goods for $18. Both entities have their own sales, costs, and profit, but when we consolidate, we've got to think of these companies as a group, and we only want to consider the transactions that hit the group. So if we think about this, the only sales that went out of the group were the 18, and the only purchases that came into the group were the 8. So how will we consolidate the 2 P&Ls? We only want to show the sales that went out of the group, 18. We only want to show the cost of sales that came into the group, 8. So we're looking for a profit of 10. When we add up the bottom line of profit, that works. We get a group profit of 10. But if we add the sales together, that becomes 28. So we need to reduce group sales by 10. That's the intra-group trading. If we look at cost of sales, look at this. -8 plus -10 is -18, but we need an 8 there. So what we do then, we just add 10. -18 plus 10 is -8. These adjustments are called intra-group trading, and we subtract the intra-group trading from sales, and then we add the intra-group trading to cost of sales, because we've got a -18 plus a +10 is then the -8, the 8 cost of sales for the group. Let's look at the next complication. And it's the same situation. P acquires 100% of S at the beginning of the year. P does $10 of sales, and P buys 2 units at $4 a unit, so their cost of sales is $8. Okay? Let's look at the complication now. P sells all of their goods to S, however, S only sells one of those units out of the group. So if S bought 2 units at 10, 1 unit would be -5, would be a cost of sales of 5, and they sold that out of the group for 9. Okay? Now, the new complication is that we have some closing inventory in S's books. S bought the goods for $5, but the cost to the group was really $4. So look at this. We have a difference. This bit we would call unrealized profit, hiding in the closing inventory of S. So if we make the same adjustments that we did before, we want to remove the intra-company trading, -10 plus 10. Let's see what happens. We've got group sales of 9. We've got group cost of sales of 3, so we have a group profit of 6. Let's now think about the transactions At the group level, the external sales were 9. That's correct. But the external cost of sales are really 4, because if we bought 2 units and we only sold 1 unit out of the group, then the cost of sales should be 4, not 3. So guys, we have to fix this with 2 adjustments. The first adjustment will be to the group inventory, because the inventory in the group is valued at 5. It really should be valued at 4. This extra 1 is unrealized profit. That was never sold out of the group, so we should think of the inventory having a value of 4. That means we reduce the group inventory by 1, and we also need to reduce the group cost of sales by the same amount, because we need a negative 4. We sold 1 unit out. So look at that. Now it works. And we call this adjustment the provision for unrealized profit, or ERP, or PERP, depending on what you want to call it. Let's recap what we did. First thing we did was we reduced group inventory. That would be a credit to group inventory of 1. Remember, inventory is a debit balance, an asset, so credits reduce it. Now, we need a debit to group cost of sales. Remember, expenses are debits, so if we debit cost of sales, we'll increase it by 1. So those are the adjustments. And ladies and gentlemen, we've completed our consolidated statement of profit or loss. This brings us to our final adjustment and how we will be dealing with consolidated statements of profit or loss going forward when we do more comprehensive examples. We will add more information to the bottom, and we're going to make a section called Profit for the Period Attributable to. We're going to add 2 lines below that. We've got the non-controlling interest and the parent. And the division of profits needs to add up to the total group profit. So if P acquired 80% of S, the non-controlling interest, the sub, they are entitled to 20% of their profits. So I'm going to take their original profit and I'm going to multiply by 0.2, the part that they own. And the profit attributable to the parent will just be the balancing figure of the group profit less the non-controlling interests part. So that would be 4.2. Okay, and that adds up to 5. Ladies and gentlemen, there you have it, the third complication to our consolidated statement of profit or loss. Hope you found this video useful. If you did, you can throw down a like or you could subscribe right here.